Hello, this is a review of the September-December 21 exam for Strategic Business Reporting released by the ACCA. I would suggest you start by downloading the exam that you will need to refer to from the ACCA website. Also, when you work through the questions with me, have a good look at each question first. Do yourself a little plan, try the numbers before you listen to my debrief. I hope you enjoy the debrief and find it useful. Thank you. I'm going to be talking about question 1 in the September-December 21 exam. That question again called Chuckle. 30-mark question with consolidation techniques. But as always, you don't have to do a full consolidation. Many marks going for sensible explanations of what's happening. If you haven't already, you need to pause the tape, look through the question just so that you appreciate the scenario. And I suggest strongly that before each part of the debrief, you do a little plan just to sort out your own ideas before you listen to what I have to say. So, in this particular situation, the first requirement said, why is it that we could not classify Grimm as a subsidiary, why it was an associate, and that was only worth 4 marks. But let's just have a think about that first. So the first requirement is really to explain the reason that Grimm is an associate, not a subsidiary. Four marks. Year end here, 31st of March. Again, if you look at the stem of the question, then you say what knowledge is required. Surely the knowledge required is what is an associate, what is a subsidiary. So initially, you don't need to put a subheading knowledge, but initially I would get down my relevant knowledge. So just to explain the difference, as a minimum, of course, we know that associates are connected with the word significant influence. We know that the most important factor determining significant influence is board membership. So you need someone on the board. And also that sometimes indicators of being an associate are where you've got between 20 to 50% of the shares. However, board membership versus 20 to 50%, it's board membership that really matters. If, on the other hand, something is a subsidiary, it's not enough at this level just to say control, because a definition came in which he would expect you to get at least partially right. But the key thing about control, remember, is where you have power over the investee or the subsidiary. Power is the fact that you are exposed to variable returns. In other words, you've got equity shares. And finally, you can use your power to get the money. So, ability to use the power to affect your returns. So that's control. In addition, it's often associated, but this is less significant, with having more than 50% of the shares. You wonder where the 4 marks are coming from. But surely 3 of them are coming just from the fact you've got your basic definitions down, or at least 2. Now we can apply this in this context, can't we? Knowledge first, application second. What do we know? We know that they've got some of the shares. Was it 30%, I think, in that first one? Yes. So they've got 30% of the shares. It said in Exhibit 1 that they've got some shared key management personnel, which means probably they've got people on the board. Key management personnel. So on balance, therefore, it is of course an associate. And that's as far as you'd need to go on those first 4 marks. The next part of the question, the next 5 marks, asked us how things would be before the changes take place at the 31st of March 06. So for the next 5 marks, we're having to explain the accounting up to the 31st of March 06. So this is when the company is still a 30% associate. And again, it does say, doesn't it, as well, also make sure that you refer to the revaluation. So also, and refer to the revaluation in your explanation somehow. So our starting point, as always, let me just make a note that that was 5 marks. Our starting point, as always, would be to explain equity accounting. And you really want a sentence saying it's cost plus share of post-acquisition reserves. And then you do the same really by setting up the formula and doing the number. So I would start by explaining equity accounting. And then, in terms of a calculation, I'm working in millions. We know it's the cost of the investment. The cost of the investment when they originally bought the 30%, back in the first exhibit again, was 100 million. And then, as always, your share of post-acquisition reserves. So what do we know? We know that it's 30%. Remember that change in reserves is like change in net assets. It means the same, or change in equity means the same. In Exhibit 2, we're told that the net assets were 348. In Exhibit 1, we're told that the net assets were 286. So if you were looking in the soft P, again, then 30% of 348 minus 286, what's that? Yep, 18.6, 118.6. So remember, in your sentences, you're explaining this is the soft P position. Initially, again, you're explaining, I think, equity accounting in the soft P, the P&L, and OCI. Remember that in the P&L you show the share of post-acquisition profits in the year. In the OCI, the share of any revaluation gains and so on in the year. So that's where we are in terms of the accounting. But it does then say, well, talk a little bit more about this issue of the revaluation. So let's have a think about that in a bit more detail. In terms of data in the scenario, we're told that one reason that the reserves have gone up is that there was a revaluation at some stage over that period. And so during our period of significant influence, there had been a revaluation. The revaluation, again, was 15. Now, importantly, it says think about tax. So I wouldn't be writing any journals in this. I'm just thinking it through for a moment just to get our brain straight. Remember, when you revalue, you debit PPE and you credit revaluation reserve, or if you prefer, you credit OCI, whichever you think about in your brain easiest. But it does say there's deferred tax. So when you have tax, the tax at 20% would have been 3. And remember, deferred tax on a revaluation gain, you're debiting revaluation reserve stroke OCI and crediting deferred tax liability. It's a temporary difference. You're reflecting the fact that you've taken the gain now. In the future, you must take the pain when you pay the tax. So that's a standard entry, isn't it, for tax, deferred tax with a revaluation. Now, all that's happened is that within these post-acquisition reserves, within this change, some of that relates to the revaluation. The rest really revaluates to profits. Now I can see that the net revaluation, bit of maths but not too hard, even I can do this one, 15 minus 3 is 12. So if I was to now think about the reserves, so here's a bit of an analysis of the post-acquisition reserves. The post-acquisition reserves that we're consolidating in respect of this associate are partly to do with revaluation, partly to do with genuine profits, so retained earnings, now we already know the total. The total post-ac reserves we worked out upstairs here, and there were 18.6. There you are, I've just highlighted them in yellow. So the total post-ac reserves were 18.6. Now, I know that some of that is revaluation. Now, we only bring in, don't we, our share. So 30% of 12, that's this number here in blue. There we are. That's 3.6. So that's the revaluation reserve that we would have set up in respect of the little associate. So the rest, the balancing figure, must relate to retained earnings. Since the last syllabus change, to be honest, that's the only time I think I've seen any kind of reserves being tested. And if you're rubbish at reserves, it's not the end of the world, because it must be a couple of marks, mustn't it? That's all. But surely we'd get the first pin right about equity accounting. Not to get the equity accounting right would be very, very bad, obviously. In addition, I'm not so worried that you get the reserve right, but I am worried if you're saying you're going to ignore tax. You mustn't. And as you see in this question, the tax has a fairly big impact. So there's the second part of the question, dealing with this associate up until the date when the shareholding changes. If you need to, pause the recording and have a look again at the requirement of the third part. When you look at the requirements, by the way, the third part is saying, isn't it, well, will the classification change? Will it become a subsidiary? And then in part B, it does say, well, assume it is a subsidiary. So that's probably a fairly strong hint. I don't think they're going to try and deliberately deceive you by not being a subsidiary or something. So there's a fairly strong hint there. So the third requirement, again worth 5 marks, is to talk about whether there is a change of classification and that is on the 1st of April 06, which as far as this question really goes. And when you're just thinking around this with your brain, so you've got a before and an after situation. So the two companies, we were called, what were we called? We were called Chuckle and they were called Grim. So before, Chuckle, Grim, 30%. After, well, that's where it becomes a bit debatable, isn't it? Because it does look as if they're buying another 18%. 48%, but later it talks about the option to buy some more shares, and it does say potentially the shareholding could go up to 60%. So that's the issue, isn't it? It was 30. Are we going to 48 or are we going to 60? It's one of those areas where it's difficult and technically, sensitive. So if in your answer you're using words like it might be because of this and this, it's absolutely fine. That's absolutely fine. It's a very, very technical issue. In the accounting firm, they'd want to talk to a technical partner about what's actually happening there. So there's our scenario. We're trying to decide what's happening. So there are two possibilities, aren't there? So either it's 48%. If it's 48%, that is linked to significant influence as before, and it's an associate. Or it's 60%. The 60% again refer to down towards the bottom of Exhibit 2. In that case, it's control and it's a subsidiary. So, as always, what I'm trying to do initially is to think about the knowledge that's relevant. What knowledge is relevant to this question? And then I can start to apply it in this particular scenario. So there's my knowledge. Now, in terms of trying to apply this, or application, well, it depends how much you know, because you might know nothing about this, and you might be saying, I've really never heard of a situation like this. Technically, the accounting standard does say you should take account of potential voting rights as well as existing voting rights. The point is, if they exercise these options, they could then take control. So that points towards it being a subsidiary. In this case, it's strange, isn't it? Because it doesn't give the prices precisely, but if the share price is 5, the exercise price of the options is slightly bigger, and you're saying, well, I don't think they'd exercise the option. But the point is, the share price is likely to go up. And also, of course, if you do exercise the option, it means that you are now in control. And everyone wants to be in control, don't they? Because they can choose the colour of the paint, they can choose the carpets, they can choose the window frame, and they can dictate policy. They do like a bit of control. So therefore, there's an indication that it may well be that they're going to exercise this option, and that makes it a subsidiary. So that's what you are trying to get across in terms of ideas. So another phrase actually that you might just fit in upstairs here is that, remember that when you go from associate to subsidiary, you've probably noticed in your learning materials, it often talks about the company crossing the control threshold. That's a good phrase to use. So crossing the control threshold when it becomes a subsidiary. So the points coming out in terms of the scenario is that, the key point is that they may exercise the option in order to get control. The learning point is that the IFRS, so the accounting standard, says that we should take account of potential voting rights should take account of potential voting rights. And so on balance, so you could talk a little bit about the price of the option if you'd appreciated that when you read the question. So I'd be quite free to say, well, it may well be a subsidiary. And of course, if it's a subsidiary, therefore, it should be consolidated. And then when you start to think about that, you're then saying, well, how does the consolidation work? Do I take account of the option somehow? Is this something to do with a question on financial instruments? Trust me, it won't be. So don't worry about how they account for the option. I'm not sure that any consideration has passed for it anyway. So forget about that. Put it out of your mind completely. What it does mean is that when they do the consolidation, technically at the moment, they only have 48% of the shares. So the non-controlling interest is going to be 52. Well, big cheese, that doesn't matter. You can have a large non-controlling interest. That's really, isn't it, just like any government at the end of the day, where about 10 people have control of the government and 60 million are kind of the non-controlling interest, which is probably you and me. So it's fine. You can have a big NCI. It's absolutely normal. So that's the third requirement. In the next part of the question, and don't forget to pause the recording if you want to before you go on, we're then asked to think about the fair value of the various assets at acquisition on the assumption, again, that it is actually an acquisition and the company has become a subsidiary. So section B1 is very much about the fair value adjustments. And if you've been looking at a number of these questions, it must by now have sunk in that if you don't know about IFRS 13 fair value adjustments, you need to learn it. It's a very important standard, fair value adjustments, tested widely recent past, and it will be in the future because it's so significant in terms of acquisition accounting. We've got to explain those adjustments, and most of the words about this are set out in Exhibit 3. In terms of knowledge initially, of course, you need to explain what is meant by fair value. Don't forget, I don't write standard numbers because you don't have to and they won't get any credit, and it just causes confusion for the markers if you quote the wrong standard number. So the message about fair value is, isn't it, that again, that you must measure the assets and liabilities at fair value. That fair value, and I'm shortening the definition, but it's the price that would, for example, be received. This is thinking about assets, again, on sale in an orderly market. In a transaction between market participants at the transaction date But the other thing that's in this question is tax. It says that the fair value adjustments are subject to tax. And when you've been looking at deferred tax, you've seen that just as revaluation gains that we talked about in part A of the question are subject to deferred tax, so too are fair value adjustments. And really, you must be calm about tax. Look, if the tax rate is 20%, if something goes up by 5, the tax is 1. If something goes up by 10, the tax is 2. That is the end of our knowledge, isn't it? So it's very, very, very straightforward. It's the same logic, though, as with revaluation gains. Tax will be paid in the future when the asset is ultimately sold. So the other point in this particular scenario is that the fair value adjustments are subject to deferred tax. It's fine. Now, I would explain each of the adjustments in turn, but just to try and keep life a bit simpler on this debrief, and so you don't fall asleep, I'm just going to do a little bit of a calculation or working. Because what we've got actually is we've got 3 fair value adjustments being discussed. We've got some land, we've got some inventory, and we've also got some kind of database. For each of those in Exhibit 3, we're given information about the fair value adjustment that's being made. So just look back at Exhibit 3, again, if you need to, just to check the numbers off. First of all, I've got the land, and we're told that the fair value of the land was 60. So I'm just putting FV. We're told that the carrying amount of the land was 50. $60 minus 50 is 10. That will be subject to tax. Tax is at 20%. That's 2. 10 minus 2 is 8. We've got some inventory, the finished goods. The fair value is apparently 131. The carrying amount of the inventory is 84. It's an increase of 47. 20% of 47 is 9.4. That would therefore give me, I think, 37.6. We've also got a database. And again, you must recognize, remember, all identifiable assets. Again, even though they're not originally recognized in the company's own books, they'll be recognized in the group accounts. An external party would be prepared to pay 5 for this, the price at which it could be sold. This was not in the books, so the carrying amount was nothing. 5. 20% of 5 is 1. And there are my fair value adjustments. So clearly, you could expand it a bit. Again, certainly when you refer to database in your explanation, you would want a little bit more, because I would want you there to again define intangible asset. Remember, the key word is identifiable. Sometimes when I'm marking, I see people say that an intangible asset is not tangible. And that's like saying a tangerine is not a coconut. It's not a good thing to say, but identifiable is the key word, isn't it? Something that could be separately sold or gives legal or contractual rights. But there we are. We've dealt with the fair value adjustments. Pause the recording if you need to before we look at the last part, which is part B2. Part B2 asks us to look at the goodwill on the subsidiary and also to describe the accounting treatment on the acquisition of the extra 18% of the shares. So 2 things being asked for in B2. I need to explain the accounting on the acquisition of this extra 18%. And then I need to explain the goodwill. Key thing, remember, is that in this scenario, because of the existence of the options, then you have crossed the control threshold. Sometimes people refer to this as a step acquisition. I don't think those words are very important. I mean, they don't really want to know what it's called. They want to know what the accounting is. But the point is, isn't it, that when you've acquired this, extra 18%, you de-recognise the associate, and you start to consolidate the subsidiary. So I de-recognise the associate and consolidate your new subsidiary. Remember that when you go from A to S, there'll be a gain or loss on derecognition, which you would have to calculate. And remember that that gain or loss goes to the P&L. So we'll just try and squeeze that in here. Units of measurement, £1,000,000. So I need to know, don't I, the difference between the fair value of the original stake of 30% and its carrying amount. So I need to compare the fair value of the 30% on the date of the change in stake and the carrying amount. Where's the carrying amount? It's much earlier in our answer. So we worked out the carrying amount, and of course you would get your follow-through mark. The carrying amount of this, way back up here, was 118.6. We worked that out in requirement A2. So 118.6 is the carrying amount. The fair value is given in the question. In this case, the fair value is 127. So the gain is the difference between the two, 8.4. Remember, the whole of this exam is calculating numbers and telling directors where to show them in the accounts. In addition, for this 8 marks, we've got to explain and calculate goodwill. The key thing, again, is using all the brought forward information now as you put forward a final set of numbers for the goodwill. So as usual, 2 columns in your spreadsheet. We know, don't we, that goodwill is the difference between the consideration, then the NCI, less the net assets. Consideration, we've just paid for the 18%. That's already expressed in today's terms back in Exhibit 2. The 18%, that's actually the cash that we've paid, and that was 66. The old consideration must be measured at fair value. That's the 30%. It's the same number as we've referred to up here. It's this 127. So as far as the old one goes, there we are, 127. I own 48%, so the minority own 52%. We're using proportionate goodwill, so we can't work that out until we know what the net assets are. Now into the net assets. All this now really in Exhibit 3 plus what we've already done. We have a draft figure for net assets in the question, which was 348. just at the bottom of that little total of the assets listed. And then we've got the adjustments. These adjustments are all coming forward from the earlier part of the question. So these are coming from part B1. We've worked these out. We've got the land, inventory, and the database. So let's just look back for a moment. So it's these numbers, isn't it? Just being highlighted now in blue. 8, 37.6 and 4. 8, 37.6 and 4. So if I add that through, good. 397.6. A lot of follow-through marks here. So 52% of the 397.6 is for the NCI. So I think that's 206.8. $66, 127. And I'm coming out with goodwill of 2.2. It's interesting, when I'm teaching in the classroom, students watch me do that and then they say, well, I think I would have written more. And that's fine. So if you can write more in the time, yeah, write more. They'll enjoy you, that's fine, it's good. But the key thing, remember, is you need to have a stab at each part of each question to make sure you're getting the easy marks. There you are. That's my review of question 1.